Okay, perfect. I don't know. I don't see to have any feedback, but if you can hear me well, I believe you. Okay, welcome, folks. This is the first live video since we moved here, and we have lots of new subscribers too. So that's good for those of you that have never been to this live video before. So let's proceed. We have enough people right now, so we can start talking about this. And if you can hear me, or you cannot hear me, just type on the Google window your feedback and any questions that you might have. Okay, so let's take a look at this week's action. So right now, the most for me the most important development this week is finally implied volatility started to crack. This is fantastic. We are finally having the term structure coming down hard. We have VIX on the 15s, and there is a good odds of seeing 14s today, and that I like. So it's something that I have been expecting for a while now, and it's happening finally. This is making me really happy. It's something that makes me really happy. Let's take a look at how VIX price right now. Let's see what is happening to VIX right now. So 1526. So that's good. That's good. We are about to hit 14. If we have calm this week, and if next week also the early sessions the market remains range bound or quiet, or it keeps moving up, I think VIX will be able to go into the 14s, and that's something that I would love to see. Near-term implied volatility is already on the 14s. So VXXT is something that I like to use to gauge implied volatility for 1 week. It's actually 9 calendar days, but it's supposed to measure 1 week. So it's 1419, which is actually really good too, and that will benefit our position. So in that sense, let's take a look at our positioning right now, what we have, and let's comment about it. So let's comment about the positions that we are carrying since a long time ago. Those were like speculative trades that are deep underwater. They were contango trades that we started before the crash. So we have the VIX contango trade for March. This is done with March puts in VIX. So this one didn't work. I mean, it was a small trade and it didn't work at all. I just have it here listed, so just as a scar of war, like just to show my scars, just in the spirit of full disclosure. I really wrote down this trade long ago, but I carry it just for you folks. You can see that not everything works, and sometimes things will not deliver the profits, but the key here is not to bet the house on any of these things. Those were really small trades, and if they didn't work, fine, and if they work, also very good. So the contango trade for March is toasted, and it will be toasted. The contango trade for April will work really well with VIX on the 15s, and now going down to the 14s. It will open the door for this trade to work in 30 days. So we still have a month to go here, and this trade will work really nicely, as well as the VXX short trade. All of these trades suffer from being really early. We were incredibly early, and that's what happens. We enter in them before the crash, but it's okay. Those are short volatility. We know that volatility will always tend to revert to the mean. They will come back, and in the case of VXX will really go down dramatically very soon. Let's see where is VXX right now, and just out of curiosity. As you can tell, I love typing. So VXX is already below 40 and 39s, and probably going to 38s before the close. So I love it. VXX is collapsing nicely, and if next week we can finally have a week without drama, a week without major geopolitical events, I know that's too much to ask, but if the week behaves in a normal way, VXX can hit 35 really easily. So our trades will benefit greatly from it. Now, let's move to, the VIX, I was commenting about VSX. Let's move to SPX. So yesterday we opened a long gamma trade. I entered the long gamma trade yesterday. Okay, Florin, since no video, okay. I hope that is not my issue. I think I see video here. I think I'm seeing good video. So I don't know what it is, Florin. I guess maybe something related to YouTube. But for the rest of us, just let me know you can see it. But I see it. I see myself on my monitor. So the long gamma trade. Long gamma trade, we opened it yesterday. The rationale for the long gamma trade is, okay, the market realized volatility was really low. Realized volatility is collapsing. The signs were that a big move was in the works. But the thing is, we never know where the big move will be. We don't know if the big move will be to the upside or to the downside. So the long gamma trade is a combination. No, it has two legs, one downside leg and one upside leg. And they are not quite an iron condor. I mean, they are not for the same expiration. I picked different expirations because I wanted to have a little more gamma exposure on the upside leg, and I wanted to have more vega exposure on the downside leg, and it's working fine. The long leg, the call spread leg, is already making 100% on it. No, it's already making lots of money, and the short gamma, the put spread is losing 30 cents, but overall the trade is gaining 30 cents, which is like 20 something percent. So the trade is already 20 something percent up today, which is fantastic for a trade that is only 1 day old. I know that we have a massive move, and that's what we expected. That's what is a long gamma trade. We wanted a massive move in one direction or another. And remember, this trade is designed for April, so we still have again a month on this, and it's already delivering 20%. And I have the feeling with the market close to 2,780, I have the feeling that this trade will be in the money by next week. Well, what that means is by next week this trade will be around 2.5 easily, and that will be an early target for me around 2.5, which is around 100% return. I will start taking profit on the trade, and I will suggest you start taking profit, or at least you start taking care of the profit. Okay, so in terms of trades, we are doing well. I am glad that the first trade on the new home actually has worked really well. So, you know, for all of the new members, you will think that this is like everyday's occurrence, but as you can see, not all of the trades go according to plan, and that's why sizing of the positions is so important. You know, just always when you follow these trades, you know, bear in mind that there is risk involved. Don't bet the farm on these things, and size it accordingly to the risk profile that you have. Now, if you are a very aggressive investor, where you can go a little bigger, but if you more conservative, so you go a little smaller. So our positions, I am happy with their positioning. We have one toasted positions, two very potential good positions in the next week, and one fantastic long gamma trade with it is only 1 day old. Now this trade will deliver lots of profits pretty soon. Let's see what else we have here. So some volatility sessions. Okay, so some comment in general about volatility for those of you that have been following me in the Gamma Optimizer room before the move. You know that I had been really looking for the collapsing volatility this week. There's something that I had been looking forward for like a couple weeks away, and you can see a couple things since the crash in February. You can see that implied volatility can move up really quickly and massively. So VIX was what, 10? And from 10 we moved to about 40 something. No, it was almost 50. The thing moved high so quickly, and it was incredible. But yet, this is almost, no, not almost, exactly 1 month later, 20 trading sessions later, and volatility is still high. So notice how in the way down, volatility takes a long time to come down, and the volatility world takes a long time to normalize. So this is a good lesson. So when we want to speculate with the direction of implied volatility, we need to realize that we need to give ourselves a lot of time. So that's why the April trades are going to work fine, while the March trade was too soon. Although on my, in my defense, the March trade happened before the crash. Also, for those of you that are new, we had many other trades in between that are not listed there. We have a fantastic contango trade betting that the VIX score will normalize, and that trade was fantastic. I mean, it delivered tremendous profits already. But those are the ones that the close trades I don't track right now on my positions page. So those are the lessons. So the next time we have a dislocation, the next time we have like this kind of correction, 10%, 5%, now we know what to do. Now we wait for it and we plan accordingly, and you set the time frames of the trades accordingly to this. Now let's talk about the NDLA. I know you guys have seen the NDLA all the time. You know, I know that you have seen it performing now. For instance, today the NDLA generated a signal yesterday and the day before yesterday, and those signals were fulfilled today, and some of you folks were able to profit massively from those things. No, you were able to, I know some of you were making like 400% on those NDLA trades, and it is fantastic. No, I didn't take them because they were too expensive for my taste, but those trades are very good. So the NDLA is just a neural net. For those of you that don't know, it's just a neural net. It's looking for some kind of 1% moves up. That's what it looks for, and identifies this point. So yesterday and today it has identified those, and it has working well. The thing is, there are certain trade parameters for the new people. The trade parameter that we look for a binary trade, which is just a vertical spread for 1 week around the 1% target area, and we price it. And the NDLA trades only make sense if the price is below $1.5. Only if the price comes down below 1.5. But the thing is, it has been 1.8, 1.6. It has been just around a tad higher, so that's why I haven't done any NDLA trades in a while. But I know some of you are very brave and love to take these trades when they appear. But so more power to you folks. And but that's how it works. And also, in February, the performance of the neural net was not up to whatever we were seeing for the past years. But I think one of the reasons is that we were below the gamma threshold for most of the month. So I guess when we are below the GT level, we need to be careful with the signals. But now we are solidly above, so I guess we have the green light to start looking about them. So I want to show how an NDLA trade looks like. So let's take a look. Let's look at all of the posts. And by the way, you can ask questions anytime, folks. And okay, so we have a question. Can you explain what a neural network is? Okay, neural network is just I don't know if you have heard of the whole machine learning thing. No, machine learning is the all new thing that is back in vogue. Is the thing that is fashionable right now. So a neural net is just a way for me, it's just a pattern matching algorithm. The difference is that instead of you designing the algorithm by hand, you let the algorithm learn the patterns. You know, and it kind of like learning it implies that it's intelligent, but it's not quite that is. Learning means that the algorithm is just a very complex mathematical function, and it adjusts its own parameters to match the pattern. So it requires lots of historical data points, and you train it with these historical data points, and it learns how to identify the patterns. And that's what the NDLA is I trained the NDLA with data going back all the way to 2009. So it's probably 9 years worth of data, and it's a very complex data. I mean, it's minute to minute data. So so it's a gigantic data set. And I trained it to look for a very specific pattern. The pattern that I wanted this neural network to identify was if it could identify when the market will move 1% up. And there are many reasons for that I have explained before, and I could post the links to why that pattern. And the reason is that there is plenty of edge in option prices for that pattern. Not right now, because implied volatility was so high, the options were so high that it was really hard to do, but that's what I'm looking for. And this is how an NDLA trade looks like. So I just posted one. And in this case, for instance, around almost noon, there was a positive signal for a minimum target of 2,795 that could be fulfilled anytime from now until next Friday. So what the neural net is saying is that it's seeing the pattern, that there is a big potential. Of course, at this time, when this was generated, the market was substantially lower than it is right now. Right now, the market, I think the market was here in the 765. So the market here is already 10 points upward from where the prediction was done. And that's how it works. And this table that I post is a table for just so you can see historically what the algorithm has said in past dates. No, of course it's not infallible, it fails, but it has done well. I mean, it did well in February 23rd, and it went there, but then it failed, a couple of failures, because the market didn't fulfill the 1%. But now it has already fulfilled the prediction, for instance, from March 6th. So in March 6th, so a couple days ago, it predicted, March 7th, sorry. March 7, it had predicted that the 2,754 area will be seen within 5 days, and we already saw it. And also, it fulfilled the prediction from yesterday. Yesterday, it had a prediction for 2,766, and guess what? We are 10 points above that prediction. So it has fulfilled the predictions really nice. It's just I have not taken the trades because they are very expensive. And I have another question. So early in the week you had hope that VIX will settle in the 15s. Now that we are breaking those levels, do you think VIX could see 12 of 13 by the end of next week? And the answer is yes, Andrew. This is our famous Enceladus. So yes, Andrew, I think that it's very possible that we'll see VIX in the 12s and 13s very, very soon. And the reason for that is that look at the realized volatility. Intraday realized volatility is something that I pay really close attention to, very, very close attention, because the best kept secret in Wall Street is that VIX just tracks at a premium of intraday realized. Everyone knows that. I mean, people claim that they have these fancy mathematical models and software, but the reality is that you just look at intraday realized volatility and add a few points here and there, and that's VIX. That's how they price VIX. So right now, look at this. We have intraday realized volatility on the 7th, so almost on the 8th. So VIX could be theoretically on the 10s. With a couple, like 2 balls of premium. And even if you want to be generous, let's say you want to add 3 balls of RIX premium, it will be on the 11s. So I will say that we have good chances of seeing VIX really low. Of course, this is predated on the requirement that realized volatility keeps doing this. And that's predated on the fact that we need to be above the GT level, the gamma threshold level, and that the market doesn't receive any surprises. The volatility world, as opposed to the price world that the EWT folks follow, reacts to events. I know that Avi in the main room is very adamant that events have no impact whatsoever in the market, but that's only on the price market. In the volatility market, events are everything. Because the volatility market is about the future, it's not about the present. And events right now affect the perceptions of the future. And if something happening right now makes option dealers nervous, then those guys are going to start overpricing options, and then implied volatility goes through the roof. So that's how it works. That's what I wanted to look there about the NDLA. So it's working, and I know for a fact, I know El Manu, one of our members, was doing fantastic trades with the NDLA. I posted the NDLA early in the morning, and he took the trade because he's a brave person, and he must be sitting in so much nice profits right now. I'm glad for him, and I'm glad for all of you that managed to do this. I didn't take it. I'm a cheap person. I look for cheap trades, and 1.6, 1.5 was too expensive for me. Okay, so what lies ahead? So what can we expect going forward? So we got our expected volatility collapse and more, no? I guess we are getting even more than I expected and I wished for today. But with that being said, I expect even more in the days to come. So next week, I am expecting a massive collapse in volatility, and I guess one of the best ways to visualize this collapse will be in VXX. I am expecting VSX to collapse massively in the days to come, because it is tracking too high to where it should track. And also the VIX term structure is even though it's collapsing nicely, is still a little high for when I wanted to see it. So I think it will come down even harder. As you can see, I am very bullish right now SPX, and I will be bullish XPX as long as it is above the GT level. The GT level is not some magical thing, it's something that I compute all the time, and it's the GT level is just basically a mathematical computation where I compute the point, the price in the market where option dealers will be fully neutral in terms of gamma. So that's kind of like the threshold, the difference between having to hedge in a short gamma regime and having to hedge in a long gamma regime. So in that case, let me compute one for you folks real time. So this is I am computing right now the GT level right now. So as you can see, it takes a long time because it is using 8,000 options and crushing all these complex mathematical equations, and it takes forever. So right now the GT level is around 2718.46. So 2719, let's round it up. So as long as the market is above this level, I expect positive drift in the market. So that's the first thing I am expecting, positive drift. And also I expect the market to have incredibly low realized volatility, which is what we are seeing today. We are seeing incredibly low realized volatility of 7.77, while if you have been paying attention to this little tool, which is free and available to all of you folks, we have been seeing 19s, 20s, 25s. You know, we are seeing gigantic values for the past weeks, but now we are finally seeing something low. And I have another question. I know this is our usual topic of discussion, but if you have time at the end, do you mind discussing option strategies for future spreads? Of course, I don't mind. No, once we finish, in fact, I have a slide about that, so we can discuss it. No problem. Okay, so that was my thing. My bias is bullish, and now ambiguity. Now let's talk about ambiguity. I know that for the longest time I have been talking about this, and you folks have no idea what ambiguity is, and I try to explain it. It's a concept that is not as accessible as other concepts, but ambiguity let's compute ambiguity right now real time. So ambiguity is a statistical concept, and it can be computed. No, everything is numerical. Everything can be computed. Everything can be explored. So ambiguity is just this a statistical parameter that seeks to measure uncertainty. So in a formal definition, ambiguity is a measure of uncertainty in the market. And you'll say, wait a second, I thought that the measure of uncertainty was VIX. The difference is no, VIX is not a measure of uncertainty. VIX is a measure of risk. So there is risk and there is uncertainty. And those of you with financial backgrounds will understand the difference. Some economists think that there is no difference, but I believe there is a tremendous difference between the two. Risk is something that you can measure. So for instance, VIX is actually measuring the expectations of volatility for the next 30 days. And so that's kind of, you know your risk in advance. When you do something like VIX or implied volatility, you kind of quantify your risk in advance. So let's say that VIX is a measure of the known risks you are taking in your trade. However, the market shows, and past history has shown, for instance in 2008, that all of these assumptions were wrong. No, one of the reasons of the financial crisis is that the mathematical models that were modeling risk were wrong because they were not taking into account uncertainty. So ambiguity is a measure of uncertainty. And what is uncertainty? Uncertainty is the unknown risk, the risk that you cannot quantify. You cannot quantify the probabilities of certain outcomes. And for the longest time, even though ambiguity was present in the literature, in the technical literature, and something like Knight, a researcher created the concept of Knightian uncertainty, in honor of his name. And no one could measure it until recently. Probably back in 2015, one of the inventors of VIX created a methodology for computing ambiguity, and I just adapted his methodology and created my own secret source to measure it, and this is ambiguity. Sorry for the whole digression, but I wanted to show it. So in this chart, ambiguity is the black line, and the red line is called the probability of negative returns, which is very, is correlated, like it's related to ambiguity. It's like the computation gives you two numbers. So ambiguity is something that tends to lead the market. When you have very high ambiguity, like when we used to have here at the mid-January, the market tends to fall really hard, and sure enough, the market fall really hard. But when you have low ambiguity, so the market tends to outperform, and this is where we are. We seem to be hitting the lows, and we seem to be turning up a little bit, and that's where I am kind of bullish in the market. And that's what it is. I have a question. The question from Jim: have you considered deriving an implied ambiguity from XPX option SQs? Well, that's a very good way, and I know someone on the literature there is some literature about how we can compute ambiguity from a skew, and I know there was some discussion about for instance, the skew indicator from the CVOE. Some people claim that measures ambiguity. There are other measures of ambiguity proposed that use like volatility, something like VVIX. But I prefer this one because this measure of volatility is actually using realized returns from the past. So this is actually this is a measure based on the 20-day returns, minute to minute 20-day returns, and I like it. I like it a lot. I could share with you folks the original paper that describes how to compute this, and you can peruse it and see if it's superior or not than the option prices. So I think for me it's a full picture. I think for me is ambiguity in conjunction with other things that I'm also seeing, like VIX and like implied volatility, and also with the dynamics of the market, how the term structure looks. Okay, so let's come back at this. So ambiguity is turning up violently. I mean violently. It was like 0.06 and it's 0.14, so it's more than double today. And that is a concept because as a consequence of this, I think the upside leg of the long gamma trade has a very good odds of being in the money. So remember from our long gamma trade, which is up again, it's always wanted to go up. The upside leg is around the 2,850 area, which is 80 points from where we are right now, and I think those 80 points are very doable. I think those 80 points are within reach. We'll see. We'll see. That's what it's a long gamma trade. We'll see if we can get it or not. Next week I plan to manage profits if we start seeing like massive profits. I am happy with what we have right now, but I think it can be more. So now let's come back to the new members. I welcome you again to all of you that are new to the room. I know it's a substantial amount of new members right now, and I want to remind you of something. No, don't wait for me to suggest trades. I suggest trades once in a blue moon. I am very opportunistic person. I only take trades when I feel that the edge is good and when I feel that the conditions are right, and very very conservative. You folks know me that I only take trades when I think the edge is very good. So in that sense, that you will see very infrequent trades from me, like once in every week or two per week tops. So most of the trades we actually do in the room are actually requested by members like you. So if you have a thesis about anything, anything that trades or anything that trades and has options, then just request. You just post a request and say, hey Leo, I think that this stock will do this in a couple days. What is the best trade for that? And I will design a trade that will maximize your returns. That's what I will do. So please, start requesting away. Don't be shy. I know you are shy. You're getting a hang of what is the dynamics of the room, but the requests from you folks are the heart of the room. And doing it publicly though. You can do it in private too. You can say, oh, I think I believe this and that, but share it in public, because if we everyone shares their thesis and I share the designs, people can say, oh, I kind of like this thesis, let's do it, and I'll follow you. And that's how we have done it before, and we have had many good suggestions from members that others have followed that have played really well, in particular in the metals space. Now we have people that are really good at this, and let's do it. Also, ask questions. don't be shy. Ask me, and this also goes for all members. Ask questions. I will answer them, and you can ask the same question 100 times. I don't care. I will answer it 100 times. The reason I do that, I have a different system to other people here in the family, in the WT family. I truly believe that anytime that the same question is answered again, there is always new material. There is always something new, a new angle that you have not everyone has realized. So that's why I like answering questions many times over, because every time I answer that, I can shed light in a slightly different angle. And also for new and old members alike, remember that options can be used for much broader spectrum of trades. I mean, we don't have to limit ourselves to just directional trades. Options are so complex. Options offer a tremendous universe of potential trades that trades that won't be possible to execute with shares or futures. So let's leverage that. Let's leverage these weird theses that cannot be executed with shares or futures. For instance, I'm going to show you the things we can do, and this applies to the question about futures and things like that. The thing is, can we do vanilla directional plays? Well, that's what we do all the time, no? We try to do directional plays, and we bet that something will go up, we bet that something will go down. Yes, that's the most common thing we can do, and I'll be happy to do it for you. But for instance, we can also play range-bound plays. If you really think that something won't move for a period of time, or it will be kind of oscillating around a certain level for a period of time, we can do it with options. Options are perfect for that kind of thing, and that kind of thing cannot be done with shares. Also, constraint plays. Constraint plays are also similar, are kind of the opposite of the range bound. You think that the price will be everything but in this area. So we can do that with constraint plays. Like, for instance, you can think that this stock either will take off to the moon or it will crash to zero. That's kind of a constraint play, and we can do it. And in fact, that's kind of one of the plays we're doing right now with XPX. Like, that's kind of the play. Like, we knew that XPX will either go to the moon or it will crash really hard, and that's why we went into the long gamma trade. And we can also do way more advanced plays that are not relating to any underlying, but to the effects that options possess, like what I call the second order effects of options. So we could exploit nonlinearity on options. Perfect examples are the pure contango trades within VIX, the ones that were very successful in VIX. Those were really mathematical trades. Those trades were not connected to anything. Those trades were plays on just geometry. And we can do these kind of things now if you're crazy. And the same thing can happen in XPX. There are some trades in XPX, so certain calendars or certain butterflies that are not quite plays on SPX direction, but on the term structure. So all of those things could be done with options. And whenever you want to trade like that, just let me know. I can always design one for you folks. And this is something that is worth repeating. There are some lessons from the collapse of SIF. You know that SIF collapsed a month ago, and I know a lot of you folks lost lots of money on this. Personally, I know some people that lost lots of money. So my recommendation, even though you won't see it on the other areas here of the room, is please don't use leverage products. Don't use leverage ETFs or ETNs. In fact, any inverse ETF or ETN is leverage by definition. So even if it's only -1, even if you think, oh, this thing is only -1, that's a leverage ETP. Don't use them, folks. Those products have no place in the marketplace. Those products are only designed to take your money. There is no mathematical or financial justification for the existence of the products, period. I know that's not what you want to hear. I know that's what not, of course, the people from the banks that design these products want you to know. But the truth is, no professional trade these products. That's the truth. The truth is, there is not a single professional that will do trades here, because this is a space that is specifically designed to collect your money. And the same applies to volatility ETPs. And to me, I hate all of them. Like VXX, I hate them. I trade VXX, and I short it, like the question that Andrew is asking, can we short them in a small size? Of course. I mean, VXX, please go ahead and short it. Just think for a second that all of the banks that design these products are always short the product. I don't know if you notice, the nature of any exchange traded product is whoever is the creator of the product is perennially short, in particular with ETNs. No, so just think about it. Why will someone create a product that they will be always short? No, and who hasn't gone for Barclays? For instance, Barclays is the creator of VXX, and I will say that they have done really well because Barclays is 100% short VXX every second, every time. They are never long because they are the creators of the shares that you're buying. You are buying them from them or from their authorized, whatever they call the people that stabilize the VXX market. You are buying it from someone. So those people, why are these people getting short? Just think about it. And the same happens with the inverse volatility like XBXY or CIF or whatever. My recommendation is use at your own peril. I will not use them. I will not design trades for those things. I will not recommend playing them, and even less with options. So that's kind of the lessons. And then what else? Okay, let's take a look quickly before opening the room to questions. Let's take a look quickly to the time structure. Let's look at the time structure of how it's looking, the time structure. Let's remove the today that is too noisy. Look at this term structure. This is a gorgeous and beautiful term structure. When I post this chart, the blue lines represent current values in real time, and the red lines represents the values from yesterday's close. So you can see what is happening today versus yesterday. So you can see right now that implied volatility is collapsing very nicely across the whole term structure. Remember, the term structure is expirations between 0 days and 200 days. Right now, I could, show like the full thing. If you want to see like the full 1,000 days of this, I can show it too. But it doesn't matter what I use. You can see that there is a nice contango. This is like the 1,000 day, and you can see that we are, with the exception of the 1,000 day, we are coming down really nice in the next 2 years. So I like it, no? I like this curve, and this is what I call contango. What is contango? Contango is when the near term is lower than the far term, that things that happen farther away. Let's look for a whole year, 366. For a whole year, so we have contango nicely, but in the near term there is still some flatness, some inversion. Like I bet that this is related to the Fed meeting. And I bet that's what it is. So I'm pretty sure this area right here is around where we will have the first interest rate raise of the year. So I guess everyone is scared of that and of what is coming. So market is kind of pricing a little volatility here. But once we clear that hurdle, you can see that the shape is actually very good and it's coming into contango. If nothing happens, if the world doesn't end in that meeting, things will be really, really nice. And lastly, let's look at the gamma imbalance. I like to compute the gamma imbalance, which I have showed you many times before, but it's another chart that I post from time to time from the market. This is the gamma imbalance. Look, I don't know if you remember yesterday, we were or a few days ago when I posted, we were here in the 2,725 area, and look, suddenly we are like above 75. So we just crossed the 2,750 hedging wall like butter. We just move like butter, and there is almost nothing here. And my thing is 2,800 will be like a big test, and you can see there is a tremendous imbalance. For those of you that don't know, the gamma imbalance shows you the amount of money in millions of dollars that option dealers will have to if the market moves 1%. So that means that, for instance, the 2,800 strike, they will have to hedge more than $20 billion of extra hedging if the market moves there. So it's a massive hedging in the way up, the blue line. In the way down, you can see if this thing falls towards the 2,750, they will have to hedge also around 20 billion, probably $17 billion here. So it's a lot of money. And it gives you an idea of where the market will pause now, and the strength of the market. The fact that we were able to cross the 2,750 hedging well like nothing means that there was a lot of organic trading. Lots of outside traders beyond option hedgers came into the market and bought the market, and that's good. And lastly, let's look at I know you have gotten this question many times before on how to use the trend tools. So one of the ones that I use the most is the slow trend plot. And this clearly, since the morning it was showing a green bar for the day, and I don't know if you remember on my notification in the morning, I say I expect a trend day, and we got a trend day. And the confirmation for the trend day is this. There is a trend at the day level. So you can see a positive trends here. And in the fast trend is just from 1 to 10 minutes, and you can see, I mean, if you like to trade at those speeds. I created this because someone requested it. So you can see the trends. You can see that the last 3 and 4 minutes we have massive upside trends, and kind of like, the rest of the time there is no that many trends. And finally we have the M5 trend, which is the long-term thing, and you can clearly see that the momentum for the market is turning up nicely. And the momentum for the market is this magenta line. It's not quite the magenta line, it's the slope of the magenta line. So right now the slope is positive, so momentum is positive, and that's what gives me hope for all of the trends we already have going on. And I mean, I'm sorry, I apologize if this comes too fast to you guys. There are plenty of YouTube videos where I explain all these things in detail. I just wanted to give you a nice overview of them if you were curious. No? Let's see what else I have here. Oh, questions. So this is open for questions. Maybe we can go back to the question about future spreads. What exactly is that you are looking for future spreads, and why do you want to use future spreads as opposed to like equities spreads? Well, I know there is a delay. I guess when people like to trade future options, they do it because they think that the margin is lower. But I don't know if that's always true. I mean, for instance, all the trades that we do in our room are debit trades, so they are very cheap. They don't require any margin. But I know some trades that I don't do. Spreads in commodities. I see. So those are no option spreads. Those are like pure future spreads. So yes, exactly, like contango trades, like similar to what we did with the VIX futures. Oh yeah. Well, there is plenty of material there. I can give you kind of like a preview, a small preview. The most popular trade is a butterfly trade, but it's not a butterfly trade like the normal options butterfly. A butterfly trade is you pick a month and you short 2 futures of that month, and then you cover with the previous and the next month. Butterfly trades are really great trades, in particular in commodities that have high realized volatility like natural gas and interest rates. There are plenty of butterfly plays with interest rates, but this is like way beyond the scope of what I want to say. I used to play euro dollar futures like that, like in the futures space, and I can point you to like material for this, if that's fine with you. It's not option related, but it's really cool. I mean, they're really cool. It's a completely different space, but yes, it's doable and you could trade it. And I'm telling you, the most popular trade is a butterfly. There is another trade that is called the switch. The switch is trading. We do the switch all the time. My contango trades in VIX are kind of variations of the switch trade. The switch trade is a trade when the active month changes. The active month changes, and you can do a statistical analysis about the distance between the active and the second month at the switch, and you can tell sometimes the curve for any of these commodities will be distorted, and you could bet that the spread will go back to the historical switch, and that's also a very common trade, and that's pretty much the nature of my trades with VIX I was doing last year. So, but you can apply it to natural gas or oil or gold or anything. Anyway, any other questions related to the room or to options? Don't be shy, folks. Just type it on the Google chat. No, that's where I'm looking at the questions. I'm looking at the Google chat. Although I don't know, I bet that some of you folks are posting them. Let's see. No one is posting them here. Okay, I have a great question. What concerns do you have with such low liquidity? Do you believe we have a change in the market microstructure? That's a fantastic question. Here is the liquidity indicator, courtesy of Nanix. This is not a plug for Nanix, although, you know, if you are a sophisticated trader with institutional backing, I guess this could work for you. The Nanix provides data services for like professionals. No, but I mean like really truly professionals. It's like they provide the whole access to the full market. So anyway, Eric Honseidner, the creator of Nanix, is gracious enough to share with us his very humorous liquidity indicator. The liquidity indicator just measures the ability of executing trades in a certain period of time. I think for him it's 5 minutes or 10 minutes. Like he's measuring the size of the available trades on the book versus the volume that has happened in the same period of time. And right now you can see that we are in tier 1 liquidity. What that means is the current market, this is liquidity for ES mini futures now. The current market cannot absorb. I mean, it's shameful to see a market like this. There are no liquidity providers. There is more volume that it could be absorbed by the book, and that's sad. And it's very sad because that's what causes price to fluctuate so much. And I do agree. I think market microstructure has changed forever, and I think it's a regulatory thing. I think it's related to regulations. I think that the death of traditional market making is what brought us to this point. The exchanges favor a certain type of customer. I mean, in the past 10 years, the high frequency traders were favored over any other type of trader. No, so when you are a high frequency trader, the exchanges will, and this is just a matter of money. Exchanges were deriving most of their income from them. They were generating lots of money. The exchanges loved them. They catered to them, and high frequency traders became de facto liquidity providers. So normal market makers, classical market makers were there because of regulation. And exactly, Andrew says that they narrowed the spreads and killed traditional market makers. Exactly, they killed the traditional market makers. There was no way you could compete with them. So traditional market makers stopped doing that and became high frequency traders themselves, no? Because that's where the money is. For instance, you can see interactive brokers. Interactive brokers used to be one of the biggest market makers ever. I think it was called Timber Hill. I forgot the name of the Timberlake. I forgot the name. I think it's Timber Hill. And they quit it. They quit market making. There is no point. There is no money in market making. So what happens is that the liquidity providers are a complete different breed. And this breed that is providing liquidity is not interested in making markets to you at any time. If they don't like the conditions of the market, they don't come to the market, and that's it. And this is what is happening right now. Like most of the usual liquidity providers that used to keep us here in world class, they decided that they don't want to make markets anymore in SPX, and maybe bonds are better, maybe like foreign currency is better, like there is something else better, and they are doing that space, and eventually they might return, but we'll see. Any other questions, folks? I mean, we have already almost an hour. Sorry for taking so much time from you, folks, and any other questions, please. Okay, so if we don't have any more questions, let's wrap up this. Thank you very much for attending this presentation. Send me messages in the room, ask me questions in the room. I'll be available for you folks. And if you want to have another live video soon, just let me know. I like to do this frequently, but not as frequently so you get tired of me. Maybe once every 2 weeks. And thank you, folks. I also enjoy it. Have a great afternoon.